Good evening, this is Kim. I'm going to record this is the first one of two videos for week 7. In your homework, I asked you to look at some qualitative information for a stock of your choice. And that information involved looking at the market share, information about the CEO who's running the company, about the industry as a whole, what makes this company special, those types of things, just things we can talk about. For example, if we were talking about Chipotle, well, how does Chipotle differentiate itself from another fast food restaurant? And your response might be, well, it's all fresh and they're concerned about the quality of food that they deliver, etc. That's what I wanted you to do. I just wanted you to think about the company on a qualitative basis and identify how successful the company is, or maybe not. I mean, does it have a large market share? Does it have the potential to grow? Those types of things, because we want to invest our money in really strong companies. So we need to look at the companies we're going to invest in from both a qualitative and quantitative standpoint. So right now, before I do the quantitative component for this week, I want to go over some notes. So I'm going to direct your attention right here to this quantitative analysis notes. I want to talk about a few of these indicators before I ask you to start looking things up and evaluating. So the first one here is the PE ratio. PE stands for price earnings ratio. And what it is, it's a valuation measure that we use to determine if a stock is potentially overpriced or underpriced. That's how I would say it. So I wanted to tell you that it equals price divided by earnings per share. And I think the best way to explain it is to talk about two companies A and B, and these companies compete directly. So they occupy the same marketing space. An example would be Lowe's and Home Depot. You could think of AT&T and Verizon. You could think of Macy's and potentially Nordstrom. So anyway, they're competing for the same customers. So if we had companies A and B and the price of their stock today was $40 each, so they were both the same price per share. Now, company A had an earnings per share of $5, and company B had an earnings per share of $4. So we could easily calculate the PE ratio. 40 divided by 5 is 8, and here 40 divided by 4 is 10. Now, the way we want to think about that lies over here in the conclusion. What we're saying here is that for every $8 of earnings, or every $8 of the price, uh, we're paying that for $1 earned. Okay, we're paying $8 for every $1 earned for company A. Now for company B, we're paying $10 for every dollar earned. So you have to ask yourself, do I want to pay $8 for a dollar of earnings, or do I want to pay $10 for a dollar of earnings? And I guess you're going to say that you want to pay 8, that you would prefer to pay less money for the same amount of earnings. And that is in fact true. These PEs are important because they allow us to see if potentially a stock might be overpriced, because here this one for $4 of earnings, we're still paying $40, and that might be too high. We might think this price should be low. Or conversely, we could say, wow, for $5 of earnings, this price should be higher, which would then increase this ratio a bit. So either way, we're looking for a lower PE to indicate some potential value in a stock, or the ability for the stock to grow in price. Now that being said, I want to direct you to something else. There is industry PE ratio. So now I told you company A and B compete directly, but then there's a whole lot of other companies who occupy this industry space. So if company A and B were Home Depot and Lowe's, in the industry might include every other home improvement store. Maybe it has Ace Hardware or some others. That would be the industry. And what if the industry PE was 20? So its price earnings ratio an average was 20. Well, what that would tell me is that, wow, maybe both A and B are undervalued because both of them are significantly lower than 20. So, and that could be the case. That could be very well the case. And we care about this industry because when we're looking at all these quantitative factors, we want to see how it compares to the broader picture, the broader market for these different industry sectors. So now I want to go over here. Let's take a look at the Home Depot. So when I type in symbol, home, I can start typing, for example, Home Depot up here, and it's going to pop up in my menu, and I'm going to select the Home Depot. Okay, just right here on the summary page, I notice right over here that I have a PE ratio right here, trailing 12 month, and that's the one I want you to use. PE ratio of 23.34. Okay, well, it's already calculated for me, so I don't need to do the math. Now I'm going to go ahead and I'm going to look up Lowe's. So I'm actually going to, instead of switching this, I'm just going to pop into finance.yahoo here also. And on this side, it's a bit slow. In my quote lookup box down here, I'm going to type in Lowe's. And there's Lowe's. So I'm going to notice here that the PE ratio is 24.37. So those are actually very, very close. 24.37, and again, Home Depot, 23.34. So pretty close. If I go over here on the left-hand side, I have a tab for industry. I'm going to click on that. Actually, before that, excuse me for a second. Okay, thanks for that. I'm going to have to talk a little quieter because I've had a cold and my throat is dry. Anyway, I'm going to come back over here. I'm on the Home Depot page and I'm going to skip industry for right now. I'm going to click on competitors. This might make it easier. In this screen right here, I have the Home Depot, and right down here I have the PE ratio from the front being 23.34. Two columns over, I have Lowe's, 24.37. So in my opinion, these are very, very close. But over here, all the way to the right, I note that the industry is 19.78. So the industry, again, is going to include all these other companies that are in the home improvement industry. And what this tells me is that perhaps both Home Depot and Lowe's are potentially overvalued. Okay, so it's one thing I'm going to keep in mind. The industry is rounded up to 20, but these are both higher. But relative to each other, they are nearly the same, with Home Depot being at a better advantage because its PE is lower. Okay, I'm going to move on to the next financial indicator called beta. Completely different. Beta, as it says right here, is a measure of risk of a stock compared to the overall market risk. Well, the first question that comes to mind for me is, well, what is the market? And for this class and for this indicator, it's defined as the S&P index, S&P being Standard & Poor's. And that's a measure of 500 large cap stocks really across nearly all of the major industries. And for the market, the beta is set at 1. Okay, market beta of 1. So if I go back over here to the right, I'm just going to show you something. Go to Finance Home here, and if you notice at the top right here, there are the major indicators, the S&P 500, the Dow, and the NASDAQ. Well, if I click on the S&P 500 right here, and I'm just going to look at the chart over time. Okay, here's a picture of the chart over time. So This index has been around for a long, long time, first of all. And you can see that it's gone up. Big volatile moment right here. This was the tech bubble in 2002. And then the index recovered. In other words, the index consisting of 500 stocks recovered almost to the same level before the tech bubble. And then, of course, we had this major drop. Okay? '09, recession, housing bubble. And then since then, we had a fairly large recovery in our markets, in our stock markets. And then we've had this little drawback right here as of late, and with various reasons, global reasons, Federal Reserve reasons, etc. Just all kinds of issues going on that have caused fear in the market, and we've had a little bit of a pullback. All right, and then now, anyway, this is the market, and the beta, the up and the volatility, a measure of volatility is 1. So going back over here, we want to know how our stocks will react compared to the market, compared to this market which has a movement of 1. So if you look at this table right here, you'll see that, well, I have two stocks, A and B. And stock A has a beta of 1.5. Okay? It's 50% higher than the market. Stock B has a beta of 0.5, which is 50% less than the beta of 1. So how this works is if the S&P is up 1%, stock A, in theory, should be up 1.5%. So 50% higher. It is 50% more volatile. That's how we can think about it. So if the market, if we have one of these go up days, then your stock should also go up, but even more. In fact, 50% more. Conversely, if your beta is 0.5 and the market went up 1%, your stock would not react as much. It would react half as much, only 0.5% up instead of the full 1%, because it is just a less volatile stock. Now, I want you to think about this because many stocks are volatile, and the reverse is true. If the market drops 1%, then those stocks with high betas, like this one, 1.5, will drop even more. In fact, 50% more. Similarly, if your beta is only 0.5 and the market drops, well, your stock just won't drop as much. It is not as risky. That's a way to think about it. And what if your stock beta is 1? Well, if it's 1, then it'll just move with the market. Market's up, your stock will be up. Market's down, your stock will be down about the same percentage. So if we look over here, this is the S&P 500 and this is today. The S&P 500 was up 15.91 or 0.8%. Okay? Again, if your stock had a beta of 1, then your stock should be up about 0.8%. That's how you could look at it, in theory. It doesn't happen precisely, but that's sort of an evaluative measure to see how volatile your stock is. And it's important because let's say you are elderly, you're 80 years old, and you have some of your money, hopefully not a lot, but some of your money in stocks. I certainly hope you have that money in stocks that have a very low beta, really low, because then the market fluctuation, the up and down in the market, wouldn't not have a significant impact on your stocks. And you can think about it, usually stocks that we buy regardless of economic conditions, and we still buy groceries, although we may not go to Whole Foods. We still have to buy gas, we still have to buy things like that, regardless if the economy is strong or if the economy is weak. So you could think about it that way. Those stocks of those betas are probably not that high. Conversely, if we're talking about Tesla, for example, well, if we have a huge market upswing and we're all happy and everything, Tesla will do very well because people will feel like they have money and they will buy Teslas because they're cool. However, if we go back into a recession, Tesla will have a hard time because we have a tendency to hold on to our money when economic times are not so great. So let me give you an example. Let's go over here. Let's look up Tesla. So over here, you can see Tesla's beta is 1.39. Okay, significantly higher than the market. And let's look up another. What's some place we always go, kind of despite what's happening in the world. I think in class I use Procter and Gamble because you may not think that you use Procter and Gamble products, but 9.99 times out of 10, I bet you do. So I'm gonna key in here Procter and Gamble, and their beta is zero point 0.9, so it's not as volatile as the market. It's just going to kind of move along. Let's look at Home Depot. So HD for Home Depot, beta 1. So it's going to follow market movement. It's not significantly less risky or more risky. Okay, I think that's enough about beta. I'm going to move on and I'm going to talk about the third item here, which is called return on equity. And what this is net income returned as a percentage of shareholder equity. So if I'm a shareholder and I invested money in a company, I would really feel comfortable knowing that the net income was as high as it possibly could be for my investment. So here's an example down here. Let's say we have company A and B and they both have net profit of $100 million dollars and $200 million. Dollars. And they have shareholder equity each of 1,000 or 1,000 million. That sounds strange, but anyway, we'll do 1,000 and 1,000. So return on equity is going to be 100 divided by 1,000 here, which is 10%. And for the second company, it's going to be 200 divided by 1,000, which is going to be 20%. Now, for your investment in the company, do you want to have a return of 10% or 20%? And again, here we want high. We want the most net income returned as a percent of what we've invested in the company as shareholders. So in this case, company B would look better in terms of ROE. And I put down here, of course, we want high. So let's pop over here to the Home Depot. And although I'll show you this in your homework assignment, I'm going to tell you right now that this information is located on Key Statistics. So on the left-hand side, you'd click on Key Statistics. And within Key Statistics, don't be overwhelmed. This is easily navigated once you understand it. Management effectiveness. This is where we'll find return on equity. Well, look at the return on equity at Home Depot. 66.97%. Okay? In and of itself, I mean, if you were going to buy a home improvement company, we would want to look at this compared to Lowe's. So let's pop over here in Lowe's and let's go to Key Statistics. Okay, here it is again. Return on equity Lowe's, 28.44. And again, Home Depot was 66.97. So if we were comparing these two companies, Home Depot would win hands down here because its return on equity was significantly higher. All right, last area I wanted to discuss for the notes included how do we make money in stocks? Two ways primarily, although there may be a third, which is called stock splits, but I'll go over that later. One is price appreciation. That is, we purchase the stock for uh, $20 and it grows in price over time, and then we sell it. And so now we have a gain. We have a gain of the selling price minus the purchasing price. And that's price appreciation, and that's called a capital gain. Capital gain. So if I'm looking at over here at Home Depot and I go to I'm going to go back to the summary page, and I'm going to over here on this chart, I'm going to say that, hey, we bought Home Depot 2 years ago. 2 years ago, let's say we bought Home Depot. So I'm going to look at a 2-year chart, and I'm going to ask you, over the last 2 years, this is time, this is price. Have we made money in Home Depot? And the answer is yes. Despite all these interday up and downs, the long term over this 2 years, the price has gone up over time. And this again is the share price of stock. So we would have made money. I'm going to go ahead and add in here. I'm going to put in Lowe's. Let's look at both of these on the same chart. There's Lowe's. Now, interestingly enough, the price pattern for Lowe's is very similar to that of Home Depot. So really, over the last 2 years, we would have made money in Lowe's as well. That's what price appreciation is. The second way we make money in stocks is dividends. Now, you probably already know this, but we're going to review it anyway. So if I go back here, I'm just going to go to the summary page. We're just going to take a quick look. Home Depot, the dividend level, dividend amount and expressed as a percent, is $2.36. Expressed as a percent, if you took this 236 and you divided by the current price, you would have the dividend yield. Okay? It's the dividend divided by the current price. So the dividend for Home Depot is $2.36 a share. So if you owned a share on the date the dividend was declared and before it went ex-dividend, you would receive $2.36. So if you owned 10 shares, then you would receive $23.60, for example. That's the amount per share. And really, it's just for owning the stock. Dividends are paid out of profits, really to reward ownership and to keep shareholders very interested in owning Home Depot stock. Pop over here in Lowe's. I'm going to go to the summary page real quick, and I'm going to note that the dividend at Lowe's is not quite as high. It's $1.12, so it's almost half as much. But they're still paying a dividend, and they're still making money. But maybe or maybe not overall as a company as strong as Home Depot. That's something we're going to look at when we go over the homework. So we're going to stay with Home Depot and Lowe's, and we're going to evaluate these two companies side by side. And in addition to these factors that I've discussed here, we're going to look at several others. And then we're going to start making some judgment calls as to whether or not Home Depot is a better buy than Lowe's, or vice versa, or maybe both of them don't represent good investments, or maybe both of them do represent buying opportunities in stocks. So we have 4 choices to make based on this analysis, and I think that's all I have here, except to tell you that I've put a link out here to Investopedia for each one of these, and I want you to click on the link because they each have a 1 to 2 minute video that again helps clarify what these mean and why they are important. Okay, I'm signing out right now, and I will go ahead and start the recording of the next homework assignment. Thanks.